In line with getting you more opinion on markets, we have someone who looks at India from a slightly outside perspective. So now we have Rahul Chaddha, Chief Investment Officer at Mirae Asset Global Investments, joining in. Now, Mirae has about actually closer to $6 billion in Asian equities, and they've got a little over $1 billion in Indian equities invested. Rahul, great to have you with us here. Pleasure. I want to start with what we were talking with Atul here. Are things in the mid, small, and actually especially micro caps getting a little overheated and a little overdone, in your opinion?
Absolutely. Again, look, we all believe in the resilience of the India story, and India has been an overweight for us for last 5 to 7 years. What the policymakers have done over last 7 to 8 years is commendable in terms of the digitization, in terms of the infrastructure rollout, GST, etc. That's coming in the superior growth rates we're enjoying. And that kind of explains the resilience of the market versus what's happened in the rest of the Asian peers. But I think this move in mid-small caps, up nearly 35 to 40% since last 6 months, when globally Fed is tightening, balance sheet is contracting, would be a bit worrisome. And we've seen time and again. I think the momentum in India, it happened in 2007-8 also, carries a bit longer, but that would be a cause for concern.
So, the big question now is, what do you do with mid and small caps, right? And the kind of money that you have made, perhaps. Would you look at moving out of mid and small cap stocks and back into large caps?
So again, that's something we've been doing since, I would say, last 2-3 months. Look at our mid-cap portfolio, some of these mid-cap names, whether it's hospitals, real estate, or other sectors. Look, we've owned them for 5-7 years, but look, valuations look kind of fairly full here. So what we're doing is top slicing probably 10-15% and moving that to large caps. So large caps which offer value would be financials, some select consumer, and even IT for that matter.
Rahul, but some make the point that, and Atul earlier was making that same point, that mid caps and small caps are actually only making up for lost time, right? After all, they started participating only from March. I mean, the lows in March. What's the pushback to that argument?
So if you look at longer time frames, let's say 5-10 years, and with, let's say, a nominal GDP of 10% plus, I'm sure there are going to be so many opportunities in small mid caps, etc. These small mid caps would eventually grow to become large caps, and that's what we've seen over the last 10 years. But along the way, there are going to be sharp pullbacks also. So it depends on the time horizon. If somebody's got a time horizon of 3 years and doesn't mind 20-30% pullback in small mid caps, then one can stay invested. But like the way we see in markets, so much of this position in market for retail investors is held through derivatives, and that's a levered position. I think there, if you get a 20-30% correction, it can wipe off a lot of gains or capital. And this kind of I would say, advice is more for those people who are levered, who are playing the options, rather than people who have a 5 to 10 year time horizon.
Okay. Any thoughts on something like HDFC Bank? I mean, despite the bank nifty coming back in a big way, I mean, for the last couple of days, HDFC Bank continues to underperform. What would you do here?
So HDFC Bank, again, we all know it's a great company, and I think somewhere this is the merger or the consolidation kind of an thing which is kind of going through as banks tries to build up the low cost deposits. That's where a bit of an underperformance is coming. Investors wait for better clarity on execution, but fairly confident that in next 2 or 3 quarters, as the bank catches up on growth with peers, as the bank kind of provides for some of these assets from the legacy mortgage book, etc. Again, the underperformance should be a thing of past.
Underperformance in HDFC Bank should be a thing of past. Got that. Rahul, apart from HDFC Bank, in financials, right, since that's about 40% of the nifty weight, what are your top ideas?
So we continue to like ICICI, HDFC, Access, the private sector banks. I think this is where we would be, and selectively once we have a reasonable amount of corrections, or once there is a clear visibility of interest rate cuts, one can look at NBFCs also. But our view here is that near term we'd be cautious on markets. because look, RBI is not going to ease till the time Fed eases. Most people are expecting easing to happen somewhere in 23. I think it's more of H2 2024 story. And that's where markets are vulnerable to pull back. And look, Nifty has a close correlation with the US markets. And as US markets kind of face this pressure of slowing economy, kind of a weak earnings, and then continued Fed tightening, I think those markets are ripe for a pullback. And should that happen, that's going to translate domestically for the Indian markets also.
So your view is that global equities and US equities in particular are due for a bit of a pullback? Is that how you're thinking?
I think over next 6 months, we'll see a pullback in global equities. You look at the economic data which is coming out of Eurozone, that's a fairly weak data. US also, if you look at the employment figures, I think those numbers have been revised downwards. The money supply is kind of collapsed, fairly weak for the second quarter. So all that is going to result in weak economic data and earnings for US, and that's where the markets there are vulnerable for a pullback. And a similar thing translates into weaker export growth for India also. Clearly, there's a pressure on exports, and RBI is mindful of the trade deficits and would like strong macroeconomic stability. So it's unlikely that we have rate cuts in India before US starts cutting rate. So I think right now the narrative is all about inflation peaking. I think over coming months, the narrative is going to change to that economy is slowing very quickly and policymakers are not doing enough. And that's where markets become vulnerable, particularly in the small mid-caps space where there's a huge euphoria. Markets become vulnerable to a correction.
Got that. Rahul, so basically what you're saying is that from the current complaint, which is that the economy in the US is not slowing and hence inflation is still too high and more needs to be done there, you're saying very shortly the complaint will change to the fact that the economy is slowing sharply and central banks, especially the Fed, is keeping rates too high. The narrative will shift shortly. Is that's what you're saying?
I think the narrative or the complaint is going to change to that the policymakers were behind the curve when inflation was there. And now when the priority should be restoring back growth, the policymakers are again behind the curve. But to be fair to policymakers, see, it's hard for central bankers to cut rates when almost every second week you have some union in the world which wants to go on strike demanding higher wages. So you look at what is happening with this, again, automobile unions in US, you look at what's happening in Korea in terms of these unions threatening to go on strike. So I think central banks are going to wait for clear signs of slowdown before cutting rates. And that is where markets will get worried that, look, the easing which we are expecting and the growth revival which we were expecting is not coming fast enough.
And the rate cutting cycle will only present itself properly in the second half of next year. That's what you're saying?
Absolutely. I think unless or until we have a big event, like the way it happened with the regional banks in the US in Feb, it is unlikely that Fed is going to cut before next year. And look, if you look at the rupee US rates differential, that's the lowest it's been, and same is the case with most emerging markets with the US. So with that as a backdrop, what we see domestically also in India is most Indian corporates kind of are repaying overseas loans, borrowing locally. So liquidity becomes tight over there. So any prudent central bank would be hesitant to cut rates in this environment when the rates in US are sticky.
Rahul, let's talk about consumer demand in India. Now, leaving aside the top-end consumer, consumer spending arguably has been kind of weak. You said that you would look at select consumer stocks here, large caps. Talk to us about this particular space and the opportunities you see.
So clearly, investors and the companies also are trying to fathom that what is the reason for this slowdown. So leave aside the top-end consumer. I think that consumer is enjoying the benefits of a strong asset cycle. Real estate has done well. Stock markets have done well. So that consumer it's in own world doing relatively insulated. But at the middle or a bottom end, I think somewhere the consumer was squeezed by what happened around COVID. People lost their jobs because a lot of the unorganized sector was in pain. After that was an inflation surge, so that impacted. That consumer has not been able to come back. And I think the hope is that in coming quarters, as the economy does well and the pressure of inflation eases, that consumer demand would come back. But it is to be seen. So I think people are looking at this Diwali or the festive season very quickly, but very, very closely, I would say. But it is to be seen when that bulk of the consumption demand comes back.
Rahul, it's a pleasure. Thank you very much for joining us with all that perspective. Really useful to hear it from you as someone who's invested in these markets for such a long time. Appreciate it. You know,